Hello and welcome to a new video of FMTTM Future of Finance. In today's video, we're going to be discussing Ethereum. Before we get into the main body of the video, I just want to take a moment to remind you that investing always carries some level of risk, and it's important to do your own research and consult with a financial professional before making any investment decisions. This video is for educational purposes only and is not intended to be investment advice. Ethereum is a revolutionary technology that has the potential to change the way we conduct business and interact with the digital world. As a decentralized, open-source blockchain platform, Ethereum allows for the creation of smart contracts and decentralized applications that can be executed automatically and transparently, without the need for intermediaries. This makes it different from traditional centralized systems, where a single entity controls and manages the network. Ethereum is the second largest cryptocurrency by market capitalization and has been gaining increasing attention in recent years for its potential to revolutionize various industries. One of the most promising use cases for Ethereum is decentralized finance, DeFi, which refers to financial applications that run on the blockchain, such as lending and borrowing platforms, stablecoins, and prediction markets. By using smart contracts, these applications can be executed automatically and transparently, without the need for intermediaries. In this video, we will take a closer look at Ethereum and explain the basics of how it works. By understanding the basics of Ethereum, you can gain insight into the potential of this innovative technology and discover the many ways it can benefit you. So, let's start with the video. Let's start with what the difference is between Ethereum and Bitcoin. Ethereum is launched in 2015. Ethereum builds on Bitcoin's innovation, with some big differences. Both let you use digital money without payment providers or banks. But Ethereum is programmable, so you can also build and deploy decentralized applications on its network. Ethereum being programmable means that you can build apps that use the blockchain to store data or control what your app can do. This results in a general-purpose blockchain that can be programmed to do anything. As there is no limit to what Ethereum can do, it allows for great innovation to happen on the Ethereum network. While Bitcoin is only a payment network, Ethereum is more like a marketplace of financial services, games, social networks and other apps that respect your privacy and cannot censor you. What is Ethereum? Ethereum is a decentralized, open-source blockchain platform that enables the creation of smart contracts and decentralized applications. Smart contracts are self-executing contracts with the terms of the agreement between buyer and seller being directly written into lines of code. These contracts can be executed automatically when certain conditions are met, greatly reducing the need for intermediaries and increasing efficiency. Decentralized applications, or dApps, are applications that run on a blockchain and are not controlled by any single entity. This allows for greater transparency and security, as well as the potential for new business models. Now we know what Ethereum is, but how does Ethereum work? One of the technical aspects of Ethereum that makes it different from Bitcoin is its consensus algorithm. Ethereum uses a consensus algorithm called proof of stake to validate transactions and add them to the blockchain. Proof of stake underlies certain consensus mechanisms used by blockchains to achieve distributed consensus. In proof of work, miners prove they have capital at risk by expending energy. Ethereum uses proof of stake, where validators explicitly stake capital in the form of ETH into a smart contract on Ethereum. This staked ETH then acts as collateral that can be destroyed if the validator behaves dishonestly or lazily. The validator is then responsible for checking that new blocks propagated over the network are valid and occasionally creating and propagating new blocks themselves. Proof of stake comes with a number of improvements to the now deprecated proof of work system. First, better energy efficiency. There is no need to use lots of energy on proof of work computations. Second, lower barriers to entry, reduced hardware requirements. There is no need for elite hardware to stand a chance of creating new blocks. Third, reduced centralization risk. Proof of stake should lead to more nodes securing the network. Fourth, because of the low energy requirement, less ETH issuance is required to incentivize participation. Fifth, economic penalties for misbehavior make 51% style attacks exponentially more costly for an attacker compared to proof of work. And last, the community can resort to social recovery of an honest chain if a 51% attack were to overcome the crypto-economic defenses. Ethereum also uses the concept of gas, which is a measure of the computational power required to execute a certain action on the network. Gas is paid for in Ether, and the cost of gas varies depending on the complexity of the action being taken. This provides an incentive for miners to prioritize the verification of transactions with higher gas fees, and it helps to prevent spamming on the network. The smart contract make Ethereum special, which gives infinite possibilities. Smart contracts are a fundamental building block of Ethereum and other blockchain-based applications. They are computer programs stored on the blockchain that allow for the conversion of traditional contracts into digital parallels. This means that instead of relying on paper-based agreements, or even digital agreements that still rely on intermediaries, smart contracts allow for digital agreements that are self-executing and recorded on a public ledger. Smart contracts are based on a very logical structure, following an if-this then-that structure, which means they behave exactly as programmed and cannot be changed. This eliminates the need for intermediaries, such as lawyers or banks, to interpret and enforce the contract. Instead, the contract's terms are written into code that is automatically executed when certain conditions are met. The term smart contract was coined by Nick Szabo in 1994, who wrote about the concept and its potential uses in 1996. He envisioned a digital marketplace built on these automatic, cryptographically secure processes, where transactions and business functions could happen trustlessly without intermediaries. Smart contracts on Ethereum bring this vision to reality by digitizing agreements and turning the terms of an agreement into computer code that automatically executes when the contract terms are met. One of the most significant benefits smart contracts have over regular contracts is that the outcome is automatically executed when the contract conditions are realized. There is no need to wait for a human to execute the result. In other words, smart contracts remove the need for trust. For example, you could write a smart contract that holds funds in escrow for a child, allowing them to withdraw funds after a specific date. If they try to withdraw the funds before the specified date, the smart contract won't execute. Or, you could write a contract that automatically gives you a digital version of a car's title when you pay the dealer. Another benefit of smart contracts is that it eliminates the possibility of different interpretations, as the contract will execute precisely based on the conditions written within the contract's code. This precision means that given the same circumstances, the smart contract will produce the same result. Additionally, smart contracts are recorded on a public ledger, providing transparency and immutability. This ensures that the terms of the contract are visible to anyone and that the contract cannot be altered or tampered with. What are some use cases for Ethereum? Ethereum is a versatile platform that has the potential to revolutionize various industries. One of the most promising use cases for Ethereum is decentralized finance, DeFi, which refers to financial applications that run on the blockchain, such as lending and borrowing platforms, stablecoins, and prediction markets. By using smart contracts, these applications can be executed automatically and transparently, without the need for intermediaries. This allows for new business models and revenue streams, and it can also provide financial services to individuals who are excluded from the traditional financial system. For example, decentralized lending platforms allow users to borrow and lend money without the need for a bank, and stablecoins allow for a stable store of value that is not tied to any particular country or currency. Another use case for Ethereum is non-fungible tokens, NFTs, which are unique digital assets that can represent anything from art and collectibles to virtual real estate. NFTs can be bought, sold, and traded on the Ethereum blockchain, and they are increasingly being used in the gaming and art industries. This allows for a new way of creating and owning digital assets, and it allows for the creation of new business models and revenue streams. For example, it allows for digital artworks to be bought, sold, and traded as one-of-a-kind assets, and it allows for the creation of virtual worlds that are owned by the users. Prediction markets is another use case of Ethereum that allows users to bet on the outcome of real-world events, such as the outcome of an election or the price of a stock. These markets are run on smart contracts, which ensures that the outcome is determined by the consensus of the market participants and not by a single entity. This allows for a more efficient way of predicting the outcome of real-world events, and it allows for the creation of new business models and revenue streams. In summary, Ethereum has many use cases in various industries and for various purposes, such as decentralized finance, non-fungible tokens, and prediction markets. Each of these use cases has the potential to revolutionize the way we conduct business and interact with the digital world. The concept of gas is essential to understand how these use cases work and how the network can be used for different purposes. Gas is a measure of the computational power required to execute a certain action on the network, and it is paid for in Ether. This provides an incentive for miners to prioritize the verification of transactions with higher gas fees. Thanks for watching. Now you know the basics of Ethereum. If you found this video helpful, don't forget to like and subscribe to our channel. And if you have any questions or topics you'd like us to cover in the future, let us know in the comments.